Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the WorryFree Retirement with your host, the author and creator of the WorryFree Retirement himself, Tony Walker.
Well, hello and welcome to the WorryFree Retirement. I am Tony Walker, and for approximately the next 28 minutes, I'll be your guide on hopefully a journey that will allow you to see what it's like to be worry-free and understand that this show is dedicated to helping savers, hopefully such as yourself, worry less about money. And normally at this time of the show, I'm always excited to introduce to you America's favorite financial sidekick, Mr. Aaron Orander. And if you'll notice, I'm sitting in Aaron's hot seat. That's because this show is actually being recorded on January 6th, 2014, and we record this show from Louisville, Kentucky. Now let me set the stage and explain why Aaron's not here. My wife, who really does panic over weather, got very panicky last night because we had a lot of bad storms apparently coming in to Kentucky. I have to drive up from southern Kentucky to Louisville every Monday, so I told Aaron last night, I said, Aaron, better stay home. It looks like the weather's bad. Don't show up. We can't risk losing America's favorite financial sidekick. And lo and behold, the prognosticators had it wrong. No bad weather. So here I am by myself, but I'm going to be covering a lot of things for you. First of all, we always talk about the free book offer. Before I get into today's program, we want to remind you, if you're watching this particular pre-recorded program from Southern Kentucky, I would be the advisor that would work with you personally if you would like to look at any of your situation at no cost or obligation. If you're outside the viewing area of South Central Kentucky, you can go to our website. That website address is TonyWalkerFinancial.com. And for the first 10 folks from all of our markets that go to the website, as always, we're going to offer you all three of my books absolutely free. You have the Worry-Free Retirement, Don't Follow the Herd, and then my latest book, The 3 Personalities of Money. So again, the way you get these free books, it's the first 10 to request. You go to TonyWalkerFinancial.com. You're going to go to the Contact Tony spot, and then what you need to do is put your name, your full mailing address, and phone number. As well, if you would like to meet with a personal representative to review your situation at no cost or obligation, again, if you're in the Southern Kentucky area, you can click on the Contact Tony or Meet with Tony button on the website. If you're outside that viewing area, you go down to the right portion of the screen where it says Find an Advisor in your area. And we will simply put you in touch with someone who lives close by who can meet with you in person to discuss your situation in person. So again, we encourage you to go to the website. Also, we're going to have a few viewer email questions. You can also send me a question. We can try to get your question on air as well. Well, it was interesting starting off the show. You know, the last 2 weeks we've taken time to cover New Year's resolutions and what I call forward thinking and being excited about the future. And of course, I'm human just like everybody else. You know, the problem with calendars, the problem with dates, is it tends to mark time. And the problem with us human beings is we tend to want to look in the past as we mark time. And to give you an idea of what I'm talking about, I was coming up here today and listening to the radio, and I didn't know this, but today, again, is January 6th, and apparently it's called Blue Monday. Many of you have probably heard of this. I mentioned this to Tammy, the producer. She said, yeah, I've heard of Blue Monday. Well, apparently Blue Monday is the worst day of the year for depression. And scientists and theorists assume that because people have looked back over time, maybe they're not real excited about the future or their lives are a wreck or whatever, more divorces are conjured up on this day and more people are depressed. And I didn't believe it until recently. One of the famed folks in the industry of entertainment, Mickey Mouse, apparently he was very dejected as well because outside my office in the dumpster, I want to show you a picture of what I saw. This was very sad indeed. There you go. Even Mickey Mouse was in the can apparently over Blue Monday. So there he is. I don't know. Somebody must have had a rough Christmas and just tossed Mickey. Do you see that, Dennis? Isn't that awful? My wife, we're DVC members with Disney. I mean, she saw this and almost came to tears. So, folks, it's not that bad. And as we're going to talk about here, there's so much to look forward to with the coming year. The problem is when we see these types of things, when we see people depressed and anxious over their money, it reminds me that it's because people have no game plan. They have no plans for the future. They have no resolutions. And I'm going to show you a few things also you can do to start thinking about your future. But let's first of all remember that our approach, the Worry-Free Retirement, is unlike any other approach. First of all, it's dedicated to savers. And second of all, I use a unique three-pronged approach of man, which is the study of psychology. I have a background in psychology. That's one of the problems with psychology. As much as I love the study of psychology, the problem with that field is it's always looking at the past and trying to figure out and deal with the past. Folks, the past is the past. That's the problem with psychology. So that's the study of man, and that's where I came up with the book, The Three Personalities of Money. Then you have the study of money itself, economics. That's what the book Don't Follow the Herd is for. Don't Follow the Herd shows savers things they can do right now in terms of investment strategies, especially fixed annuities. We'll talk about fixed annuities in a minute and how that can help create some of what I call Granddad's beloved mailbox money. And then finally, the book which deals with this essence of God or spirituality, which was the Worry-Free Retirement, 10 Steps to Worry-Free Retirement. Now, before we move on with today's show and get into some of the economics, I do want to show for those of you out there who enjoy reading the scriptures, I'm going to show you that everybody deals with this same dilemma. Paul dealt with this dilemma, and as he wrote the Corinthians church, let's throw up this particular verse of scripture. I want to cover this. He said in 2 Corinthians 4:16, he said, "Therefore we do not lose heart." In other words, if you're one of those that are suffering from Blue Monday, you need to forget that. And he says, even though our outward man is perishing. Now let's leave it there for a second. Folks, here's what you got to realize. As we get older, it's a fact, our bodies start deteriorating. And if you don't believe me, my wife, we were on a recent business trip, and she took a picture of me from the rear, Dennis, in my boxer shorts walking through the room. She was laughing hysterically. I turned around, I said, "Susan, what are you laughing at?" She showed me a picture of me, and if I had known it was me walking through the room, I would say, "Who is that guy?" Folks, I've changed over the years. Your flesh starts deteriorating. This is what Paul was saying. And the problem is you're looking back at the past thinking, "Hey, I looked a lot better 20 years ago." Well, sure you did. You were 20 years younger. But that's not what we're focusing on here. Let's keep going with the rest of this scripture. What Paul said is, ironically, when we are focused on God, the opposite happens. He said, although our outward man is decaying, our inward man is being renewed day by day. Thank you. So here's the point. If you're thinking like my granddad thought, who was a great influence on my life, my granddad never looked back at the past. He just didn't talk about it. In fact, I can only remember one time that my granddad shared anything personal with me about the past, and it was about 15 seconds worth of information, and he moved on. My granddad lived in the present. He worked hard every day. One day he was rewarded for all his hard work by quitting work at the local phone company that he worked at for 43 years, coming home with a plaque and a clock and a license plate that says "I is retired," and my granddad received his beloved mailbox money, a pension check for the rest of his life, and Social Security he could count on. Here's the problem with that, folks. Pensions have gone the way of the dinosaurs. Social Security is in a flux. We're already hearing more and more about different ways to take Social Security. I want to cover a couple of articles here in a second. But what we need to do is set up a game plan, if you're a saver, for what I call mailbox money. So when we come back, I'm going to be talking about this concept of fixed annuities, indexed annuities, and how you can set up a game plan moving forward in 2014, how we can quit worrying about the past, how we can also, if you're a saver, be careful to look back over 2013 and think you've missed out on something. I know what you savers are thinking right now. You don't have any money in the stock market, you're tired of CDs at 1%, and you've seen all your folks and friends and buddies who are claiming they've made 20 to 30% in the stock market. Do not despair. You need to keep your hand to the plow and remember that focus on today is the most important thing you can do. So when I come back, we're going to look at where Social Security is right now. We're also going to take a look at fixed indexed annuities and also how you can create guaranteed lifetime income just like my granddad. I'm Tony Walker. You're watching the Worry-Free Retirement. I'll be right back. How How would you like to find a trusted advisor in your area who practices and preaches the same safe money solutions that I speak of on this program? Well, you can by simply logging on to TonyWalkerFinancial.com and clicking on the Find an Advisor link. Once there, just fill out the confidential profile and submit it. This free service is available to savers who are serious about safeguarding their money. So what are you waiting for? Stop worrying and log on to TonyWalkerFinancial.com. Well, welcome back to the Worry-Free Retirement. I'm Tony Walker, and you are watching the only show in the country dedicated to helping savers worry less about money. As we mentioned earlier, you're welcome to send me an email at any time. You can either go to the website, TonyWalkerFinancial.com, or you can go to Tony@TonyWalkerFinancial.com and send an email. In fact, we've got an email right now. Let's take a look at one of our viewer emails. This came from Beverly out of Louisville, Kentucky, and it basically says, what percentage of money should be investments versus cash? Now, I know where this question came from. Beverly was asking this question a couple of weeks ago. We covered the idea of having money on what I call the growth side, which would be investments, and then also having money on what I call the safe side, which would be those assets that might be similar to bank products, CDs, money markets, fixed annuities fall on the safe side, government bonds, and then I even mentioned cash. Cash meaning liquid money you can get your hands on. And the rule of thumb has always been 6 to 12 months. But what I found is the rule of thumb you need to throw out the window nowadays because of interest rates and other things. What I look for when I'm doing retirement planning is liquid money. Money you can get your hands on that's guaranteed. So we used to think in terms of putting money in the bank, and because we got 2 or 3% on a money market, we could leave 12 months worth of income. But that's very difficult to think about now and fathom, especially if you're getting 0%. So here's some sources of liquid money you might think about that may not necessarily be cash, but could be. You could have home equity. That's why I always mention to people to always have a home equity line of credit just in case. Doesn't mean you tap into that line of credit, but if you have a $50,000 line of credit available to you and you needed the money for an emergency, the interest rates are low on those loans, you can get it tax-free and then you can pay it back as you need to. Another source of great liquidity that people forget about is policies like life insurance. They're either whole life or universal life that have cash value. People forget you might have an older cash value policy with $15,000, $20,000 in cash. Those policies are highly liquid. And then finally, an area that gets scrutinized a lot and misunderstood are annuities. Most annuities have what's called 10% penalty-free withdrawals each year. So let's say you had $200,000 in an annuity. The annuity is not meant to liquidate because of surrender charges, but let's say you did need the money. In most cases, most annuities provide that every year you could take out up to 10%. So in that example, if you needed $20,000, you could get the $20,000 out. So should you have money in the bank and in cash equivalents, of course, but keep in mind that because interest rates are so low, you might have to get creative and think outside the box in terms of where money is available on a liquid basis. By the way, Social Security is the big buzzword. I'm not going to get into a big conversation on Social Security here, but I want to show you a copy of this particular book. This is what I would call the Social Security Manual. And this is what we have in our office. And notice how thick this book is. So a lot of times when people at workshops, they'll do this. They'll start asking me these archaic, arbitrary questions about Social Security. Folks, nobody is a Social Security expert out there, contrary to what people in workshops are doing. It's a very complicated process. And in fact, most people are starting to say now, the one-size-fits-all mantra of Social Security is delay it for as long as possible. What's interesting about that, I've said all along, it just depends. You may want to take Social Security early, you may want to delay it. You may want to do things like file and suspend, you may not. It all depends on your entire situation, your taxes, your IRAs, your 401ks, your health, the life expectancy of your family. In fact, if we'll go to the Elmo here, this was an interesting article that just came out. I believe it was T. Rowe Price recently found out, because everybody says you should wait till 70, their analysts studied this whole subject, and you know what they said? In some cases, taking it later is the worst thing you can do. So the point is, who do you believe? Who do you trust? It's not a matter of who you believe and who do you trust. It's who are you working with that's a retirement specialist that understands how to take this one element of when to take Social Security and couple that with a game plan. And we believe that's us. In fact, if you're watching from the Southern Kentucky area, people might say, well, this guy's on TV. I bet he works with only millionaires. I could never get in touch with Tony. That is incorrect. My goal, my mission in life is to help as many savers as I can worry less about money. It doesn't matter your situation. If you think I can help you, or if you have questions about your personal situation, go to the website or give us a call. If you're outside the Southern Kentucky viewing area, go down to that bottom button there and click on Find an Advisor in your area. There's absolutely no cost or obligation to meet to discuss your situation, and I highly encourage you to do that. Start off the new year with a resolution that you're going to get some help and have somebody give you a second opinion on your finances so you can make some sound financial decisions moving forward. That's how you create a worry-free retirement, is to have confidence and have a game plan that somebody is there to help you. Now, I couldn't go any further without talking about one of my favorite products to start off the new year, something that's got just a terrible reputation with a lot of people out there from the Wall Street side, and you've got to understand this. I recently even saw a banner ad that says, "I hate annuities and you should too." Well, if you look into that person's mantra or genre, he's from the Wall Street side. Let's kind of take a look at something called an indexed annuity and why after 9/11 I started focusing on these products. Now keep in mind, I'm a registered investment advisor. I still do some securities work, but as I got more and more focused after 9/11 on helping savers, I realized that savers didn't have a product that could get some growth but without the risk. So let's look at this product that came out in the late 90s called an indexed annuity. Now again, an indexed annuity is a fixed annuity, meaning it is not a securities product. So whenever you see fixed indexed annuity, you're dealing with a non-Wall Street product. That's why most people representing Wall Street don't sell them, because it's not one of their products. So what happens is, I'm going to use red for effect, as we see the market, maybe we go back to 07, and then we had the drop in 08, and now we know the market is coming back up very nicely. Good for the market, right? But savers, I remind you, when savers see this kind of up and down gyration, if this is already giving you the EBGBs, there's a good possibility you're a saver. Savers do not like all this volatility. Savers do not like going to bed at night wondering what the Dow or the S&P is going to be the next day. Savers like consistency, they like predictability, they like guarantees, they like a fair rate of return, not a volatile rate of return. So the problem with the market is not if it will go down, it's a matter of when it will go down. So what I'm going to do here, we're going to kind of take a break here, but what I'm going to do is show you what happens when you have an indexed annuity in this volatile environment that we've seen with the stock market, and how you can lock in your gains, and also how you can set up some of my granddad's beloved mailbox money that can guarantee you an income that you can never outlive. I'm Tony Walker with the WorryFree Retirement. You stay tuned. I'll be right back with more on indexed annuities. For nearly 30 years, I've made it my life's work to help savers worry less about money. And now I invite you to personally contact me to discuss your situation to see if I can help you. It's very easy. You just log on to TonyWalkerFinancial.com and click on the Meet with Tony link. Or if you like, you can attend one of my free financial workshops. As always, there's never any cost or obligation to meet and discuss your situation in private. So what are you waiting for? Log on to TonyWalkerFinancial.com. You know, I just read an article today, in fact, talking about this issue of savers missing out on all these huge returns in the stock market. Well, first of all, folks, as we've talked about, Dalbar did an independent study on this whole idea of the market. You have to remember that most people don't have all their money in the market anyway. So yes, while the S&P or the Dow's gone up a certain percentage, the majority of people don't have all their money in the market to make that. Most people are allocated to different strategies. So be careful of wishing you had been in the market. The second issue with being in the stock market, there is a term called realized gains, and this is very important. Let's kind of go to the graphic here, and let's say this particular person has been enjoying this ride up in the market, and maybe they have $100,000 now in the stock market, okay? Keep in mind that this money is really on paper. It is what's called unrealized gains. And as a gentleman told me once that I trained under, a dollar is not worth a dollar until it's liquidated and put in your pocket to be spent. So just because it's on paper doesn't mean you actually have it. And this is why I like the concept of indexed annuities. And again, when I was managing money back in the 90s, I was approached about this product, and it didn't make sense to me because the market in the 90s was doing so well and I was making so much money for people that I forgot to and got complacent and didn't realize until 9/11 hit that people could lose a lot of money, and especially savers, this was not a good position to put them in as their advisor. So let's take a look at the indexed annuity concept and why it is so popular and why I love this product for savers. Again, an investor may or may not like this, because what's going to happen is the indexed annuity is going to track a certain percentage of gain. Now notice, if we can kind of get this close up here, notice that it's not going to go up as much as the stock market. It's not intended to. That's because when the market goes down, we have what I call a new floor. You see, with the stock market, there really is never a floor. The floor could fall out from under you at any time. With an indexed annuity, the insurance companies writing this annuity, if the market goes down, lock in your gains. And then what's interesting about this product, as the market comes back, so does the index annuity, and they do this for you automatically. So as we fast forward here, let's say over the next year the market takes another tumble. If you have an indexed annuity, you've been riding up with the gains, but again, when the market goes down, we have another new floor. So this is why I can confidently say that everyone we've had in indexed annuities since 9/11, and we've put 1,500 people, we have 1,500 contracts in these indexed annuities, has not lost a penny as a result of stock market losses. That's because you can't. An indexed annuity, the insurance company is taking your money and they're what's called participating in the market. They're not actually in the market. In fact, in the book, Don't Follow the Herd, I use the illustration of a cow to explain this. When you have a cow, that represents your net worth, and the cow should produce milk. So the milk could be dividends or interest or whatever growth you're talking about. So the idea is you want to, if you're a saver, protect the cow. You don't want to let the cow out of the stall. You don't want to take the entire cow to Wall Street and risk getting it butchered. So what you do, and what the insurance companies are doing, is they're leaving your money, the cow is staying in the stall, and they're taking the dividends from their bond portfolio, or I like to call the milk, and they're taking that to Wall Street. Every year they do this. So when the market goes up, you got more milk, it goes back and you put the milk back in Betsy and the cow, and Betsy gets a little fatter. I know cows don't drink milk, but let's stay with the illustration. Then the next year, let's say they take more milk to Wall Street crashes. Yeah, you lose the milk. There's the book, Don't Follow the Herd. By the way, I love the cover of this book. The longer I'm around, the more it makes sense to me, and the more I'm trying to warn people, be careful. If you've been that cow in the middle on the sidelines, and everybody seems fat and happy right now with the market, be careful to jump into that line, okay? Remember, you're a saver. Know thyself. It's all right to have a little bit of money in the market, but realize the feelings you would have if you go tumbling down the cliff like those other cows. So the bottom line is here, we want to protect the principal. We want the milk to go to the market, and if we lose the milk and spill a little milk, guess what? We get to start all over again. That's this concept of a new floor. And by the way, we have another email question that I wanted to address before we run out of time today, and we kind of close this chapter on indexed annuities. It's Tony. I have a 401k and recently attended a seminar that discussed index annuities. This is why I threw this question up. More and more workshops and seminars are out there. In fact, just leave that up for just a second. In fact, what I'm finding out, there are a lot of Social Security workshops dealing with when to take Social Security. Folks, you got to realize there's nothing wrong with this, but most of the people our advisors put on these workshops, and many of these people are going to want to sell you annuities. You've got to make sure that if they're going to roll the conversation over to annuities, number one, they've been doing it a while. They understand the different types of annuities, and I would make sure, if it's me, that they are registered as an investment advisor so they can handle different aspects of your planning, including any securities that you wish to discuss with them. But anyway, back to that question, can I roll over a 401k to an annuity, and are there taxes or fees or costs? That's the beauty of an indexed annuity. No. Some people might say, well, how come I don't have an indexed annuity in my 401k? Very, very simple. Think through this, folks. Who's offering the 401ks to you? Wall Street. See, Wall Street, all of these big custodians are providing securities products, bonds and stocks. Those are all securities products, and that's all well and good. But if you're a saver and if you're looking to create guaranteed mailbox money, if you're wanting to maybe participate in the market without risk, you're not going to be able to get those products in your 401k plan. That's why a lot of people that come to us are at a point in time where either one, they're eligible to roll out their 401k because they've retired, or two, keep this in mind, maybe they've terminated their present employer for various reasons, or in some cases, if you're over the age of 59 and a half, you can roll that 401k out without any tax consequences or cost into an individual IRA, and we can put that into an indexed annuity within the IRA. Now, does that eliminate your taxes? Well, of course not. But if you get that into an IRA, now you have the flexibility and you have the guarantees of the index annuity. Plus, if you've got a retirement specialist, hopefully that retirement specialist is setting up a game plan to deal with the infamous tax tumor within the 401k. Now, real quickly, I'm going to spin this over. This is where I'm going to dearly miss America's favorite financial sidekick. I'll probably, without his help, throw this thing right off the charts here. Let's see if I can spin it around. Here we go. I wanted to show you something real quick, okay? That wasn't real smooth, was it, Dennis? With the mailbox money, I want to show you something. When you have an indexed annuity, now you might say, well, Tony, what am I going to do with this thing? When do I actually get my mailbox money? There are basically two sides to the ledger with any annuity. With an indexed annuity, there's no difference. We have the contract value. That's the part that has been participating in the stock market. That's what we call the contract value, and that's what would go at death, or if you ever wanted 10% penalty-free withdrawals, that's what you would draw. The other portion is the income account value, and this is where we get our mailbox money. This is where my beloved granddad would fall into a saver. So what we're going to do, we're kind of running out of time for today's show. I'm going to wrap up today's show, and I'll come back with our special offer next week. I'm going to cover in detail the difference between contract value, income value, and how you can determine your guaranteed lifetime income, or what I call mailbox money. You stay tuned. I'll have a few closing comments in just a second. How would you like to find a trusted advisor in your area who practices and preaches the same safe money solutions that I speak of on this program? Well, you can by simply logging on to TonyWalkerFinancial.com and clicking on the Find an Advisor link. Once there, just fill out the confidential profile and submit it. This free service is available to savers who are serious about safeguarding their money. So what are you waiting for? Stop worrying and log on to TonyWalkerFinancial.com. Well, I'm Tony Walker, and I hope you've enjoyed today's program. Again, if you'd like to get the 3 free books, the first 10 in every market, all you have to do is go to TonyWalkerFinancial.com. You'll click on the Contact Tony button, and then all you simply do is fill in, I want the 3 free books, Tony, and put your name, phone number, and complete address, and we will mail all 3 of the books: the Worry-Free Retirement, Don't Follow the Herd, and the 3 Personalities of Money. Until next time, I'm Tony Walker saying make it a good day.
You've been watching the Worry-Free Retirement with financial advisor Tony Walker. To ask Tony a question or to find an advisor in your area, log on to TonyWalkerFinancial.com.